Good afternoon. This is the Midday Brief from Bellline. Check the tape. I'm Alex alongside Morgan, and this is episode 15 of the Midday Brief. It's Wednesday, February 18th, and we're coming to you at the midpoint of a session that's been anything but straightforward. We're sitting right in the thick of a macro-heavy tape. Rates are driving every conversation, and the signals are all over the map.
Yeah, I'd say the tape has been choppy at best. We had the consumer price index print earlier, which set the initial tone, but there's still a lot left to digest, especially with the producer price index and other macro data still in play.
Exactly. The initial reaction to the consumer price index is in, but we're really only halfway through the day's catalysts. That curve is still steepening, and the long end is getting repriced as we speak. It's a classic something shifting kind of setup.
And the volatility index, VIX, sitting at 18.6, tells you everything you need to know. There's tension, but not full-on stress. It feels like the market's waiting for that next big nudge.
We're also seeing some wild outliers in the single name space. I mean, look at RXT, up 5% on the day, and that's after a 230% run over 5 days. Momentum is real, and sector read-through could matter more than usual.
Don't forget SNSE, which is up more than 180% today alone, nearly doubling back-to-back. That's not a typo. It's a momentum regime, but it feels fragile.
Yeah, and then you zoom out, and the tape itself is just chopping around. No clear direction. So today, we're going to break down the regime, the biggest catalyst so far, and what's on deck for the rest of the session.
We'll dig into the producer price index and what it means for rates and risk, but also cover the property prices, current account, and retail sales prints that hit this morning. There's plenty to unpack.
And of course, we'll map the pressure points. What's sensitive, what's confirming, and where the day could flip into the close.
So if you're looking for a roadmap into the afternoon, stick with us. Here's how the market's setting up and what you need to watch bell to bell.
Let's lay out the regime as we see it at midday. We're coming off the consumer price index print, the main event for the morning. And what stands out is that the initial reaction landed, but the tape has failed to pick a direction.
Right, it's a classic indecision day. The curve is steepening, which means the long end of the treasury market is getting repriced. That's not a subtle signal. When the long end moves, it's telling you that inflation expectations, or at least rate expectations, are in flux.
Exactly. When you see the curve steepening after a consumer price index release, it usually means the market is either worried about inflation sticking around, or, at a minimum, that the consensus on timing for rate cuts is getting pushed out.
And yet, futures are basically flat. There's just no real conviction. Nobody wants to step in and take a big position until the rest of the macro data lands, especially with the producer price index and property prices still to digest.
Volatility tells a similar story. VIX at 18.6 isn't screaming panic, but it's not complacency either. It's the kind of reading you get when the market is bracing for a move, but not sure which way.
And you can see that confusion in the sector moves. Take XRT, the retail ETF, up 1%, and XLY, consumer discretionary, up 1.4%. Both are outperforming, but the broad tape isn't following through. It's not a classic rotation, more like a pocket of resilience.
Right, and if you dig into the single name action, it's even more extreme. RXT is up 5% today, which is impressive on its own, but that's building on a 234% 5-day run. Then there's SNSE, up a staggering 185% today and almost 200% in 5 days.
That's not normal, even for a momentum tape. And CDIO is up more than 11% today, 40% over 5 days, and still a few points off its 20-day high. The question is, does this momentum hold, or is it just a side effect of choppy macro?
That's the key. When you see names like MLEC up 13.6% today and 216% in 5 days, it's tempting to call it a bubble. But there's also a sector read-through angle. Are these names telling us something about risk appetite, or is it just flows looking for a home?
It's also worth noting you've got names like JDZG down 1.5% today and down nearly 80% in 5 days. That kind of dispersion isn't just noise. It's a sign of real regime stress. Some names are getting bid up on pure momentum. Others are getting left for dead.
And with the long end of the treasury curve moving the way it is, that's not just a sideshow. That's rates volatility showing up in equities. The tape is chopping, but under the surface, risk is rotating hard.
Exactly. And then you see the credit market telling a different story. High-yield credit is outperforming treasuries, with HYG up versus IEF. Spreads are tightening, which is usually a risk-on signal, but the rates market is flashing risk off. That's a rare divergence.
So what's the market actually pricing here? I'd say it's two-sided risk. On the one hand, the consumer price index didn't deliver a knockout punch in either direction. On the other, the curve is steepening, and that means the market is hedging for higher inflation, or at least stickier rates.
That's what makes today so tricky. You've got confirmation and contradiction happening at the same time. For example, the retail ETFs are holding up, but the long end of the curve is selling off. So either the consumer is bulletproof, or the bond market knows something the equity market doesn't.
And if you look at sector performance, it's not just discretionary that's up. Utilities and staples are flat, which is unusual when rates are moving. Normally, those sectors get hit when the curve steepens, but today, they're just kind of treading water.
That could be a sign of defensive positioning, couldn't it? If people are worried about rates but still want to be in equities, they might hide in the safer sectors.
True, but the single name momentum is tough to ignore. Take RENX, up just 0.4% today, but nearly 50% in 5 days, and sitting right near a 20-day high. It's like money is chasing winners, but not taking big bets in the index.
And then on the downside, JDZG is the poster child for momentum unwinding, down 94% from its 20-day high. That's a wipeout.
And we can't ignore names like IBRX, up 33% today, or HYMC, up 29%. Each of these moves is isolated, but in aggregate, they point to a market that's searching for conviction and not finding it in the usual places.
So we're left with a regime where the macro is in charge, but nobody wants to take the other side until the next data drop. The rates market is trying to price in stickier inflation, but equities are finding selective pockets of risk on.
And you see that in the way the tape is trading. Every attempt at a directional move gets faded. There's no follow-through. It's classic chop, and that usually means positioning is getting reset.
And from a volatility perspective, it's not just the level of VIX that matters, it's the shape of the curve. Implied volatility is elevated, but realized is still muted. That points to people buying insurance, but not expecting a big move unless something breaks.
So what's the playbook for the rest of the session? I'd say it's about watching how the afternoon confirms or challenges the morning reaction. If the tape holds, you could see risk on extend. If the curve keeps steepening, equities might finally catch down.
And the credit tailwind is worth watching. If HYG keeps outperforming IEF into the close, that supports risk on. But if it reverses, that's your early warning for a broader risk-off move.
And don't ignore the cross-currents from Europe. The 10-year Bund Auction at 10:30 Eastern is a window for European rates to spill over into US Treasuries. If there's a tail or a weak bid, you could see the curve steepen even more.
So, at midday, the regime is this. Macro is dominant, rates are the transmitter, the tape is chopping, and the risk signals are split. It's a session where confirmation matters more than prediction.
Yeah, exactly. We're in a market that's hypersensitive to any whiff of confirmation or contradiction. That's why the moves in names like RXT, SNSE, and CDIO are so important. They're telling you where the momentum, and maybe the pain, is concentrated.
So, what are you watching most closely into the back half of the session? For me, it's whether the steepening in the curve translates into a break in equities or just more chop.
Honestly, it's the interaction between credit and rates. If credit holds up and the curve steepens, you could see another push in risk-on names. But if the credit market blinks, that's when things get interesting and potentially messy.
And in the meantime, the single name momentum is the best tell you have for risk appetite. Anyone betting on a trend today is playing with fire, but the pockets of outperformance can't be ignored.
So that's the setup. Macro on top, rates in the driver's seat, tape chopping, and market participants waiting for something to confirm the next leg. Every data point for the rest of the day matters more than usual.
And that's why we're focused on confirmation, not prediction. In a regime this mixed, the best signal is what actually holds through the close.
All right, let's dig into the producer price index for January, the 10 a.m. print that still has ripple effects working through the tape.
Yeah, the producer price index. Producer price index. Sometimes gets overshadowed by the consumer price index, but it's critical because it feeds directly into the PCE inflation number, which the Fed cares about most.
Exactly, and the market knows it. When the producer price index print comes in hot, it puts immediate pressure on rate expectations, especially for the front end of the curve. That's what we saw this morning. Rates jumped, and you saw a sharp move in the dollar as well.
But it's not just about the headline number. The market is looking for any sign that pipeline inflation is sticky. If producers are still seeing higher input costs, it suggests that consumer prices may not come down as quickly as hoped.
That's right. So if the producer price index surprises to the upside, you get a classic risk-off impulse. Rates spike, the dollar catches a bid, and duration proxies like TLT or triple Q get hit.
But the real nuance is in the reaction function. If the print is just in line, the market may fade the initial move and go back to chopping around, waiting for confirmation from other data.
True, and you saw that today. The initial rates move faded pretty quickly, which tells me the market was more positioned for a surprise than anything else. When the number landed, it was almost a relief.
That's such a classic producer price index day. The surprise factor really is everything. If you're positioned for a shock and it doesn't come, you unwind fast.
And that's exactly why we saw the tape chop after the print. It was a mechanical reversal, trend extension if the number confirms the regime, and a fade if it contradicts.
Let's talk asset sensitivity. You saw immediate moves in rates, especially the 2-year and 10-year treasuries. The dollar index jumped on the headline, but then settled back down.
And volatility followed the same path. Implied vol spiked for a few minutes, but then mean reverted when the rates move stalled. The options market is hypersensitive to these prints right now.
But what about equities? Did you get any real rotation, or was it just noise?
Mostly noise, honestly. Triple Q and TLT both flipped red for a few minutes, but then snapped back. The moves were sharp, but didn't stick, which tells you the market's not ready to lean either way without more confirmation.
So, what would it take for the producer price index to actually set the direction for the afternoon? I'd say you'd need a real outlier, something that's so hot or cold that it forces a repricing of the Fed path.
Agreed. And on a day with as much macro in play as this, it's not enough for the producer price index to be a little hot or a little cool. You need a major surprise to really move the needle.
Is there any risk that the market is just numb to inflation prints at this point? We've had so many, and it feels like the bar for a real reaction is getting higher.
That's a fair point. I think the market is desensitized to anything that's not a clear regime breaker, which is why the focus shifts so quickly to the next data point.
And yet, the producer price index still matters for the path of rate expectations. The Fed is watching PCE, and producer price index is an early signal for that.
Exactly. So even if the market reaction is muted, the information value is real. If you're watching for cross-asset sensitivity, the key is to look for confirmation. Do rates, the dollar, and equities all move together?
And if they don't, that's your red flag. When you get a split reaction, it means positioning is driving the moves, not conviction.
So, into the afternoon, the big question is whether the producer price index print extends the morning regime or sets up a reversal into the close. Right now, the tape is saying wait and see.
I think that's the right read. And if you're tracking the individual names, keep an eye on things like RXT and SNSE. They're momentum tells, but if rates start to bite, those moves can reverse hard.
That's exactly it. The risk is two-sided. If the rates move extends, you could see a de-risking in those high-flyer names. If rates settle down, the run can continue.
So, to wrap the theme, the producer price index set the tone for the first half, but the real story is whether the market confirms that move into the close. Watch rates, the dollar, and especially those high momentum equities for the tell.
And one more thing, don't forget the feedback loop. If the producer price index print changes expectations for the next consumer price, or PCE number, that's when you get the real repricing.
Right. So, in summary, the producer price index is the hinge. If the rates reaction holds, risk assets will have to adjust. If it fades, it's back to chop.
And in this regime, it's all about confirmation. No conviction until multiple assets say the same thing.
Next up, let's talk about residential property prices, year on year for December. This hit at 11 a.m., and while it's not always a headline mover, today it's a real check on the macro regime.
Yeah, the property price data is one of those prints that doesn't always get attention, but in a session where the curve is steepening and rates are moving, it matters a lot more.
Especially because housing is such a huge part of the consumer balance sheet. If property prices hold up, it's a sign the consumer is still insulated from higher rates, for now.
Exactly. If you look at the macro setup, the curve is telling you to worry about inflation. But if housing stays resilient, it tells you the transmission from monetary policy is still lagged.
So what did the print tell us this morning? Property prices are still running positive year on year, but the pace is slowing. That's not a regime break, but it's not a green light for risk either.
It's a nuance. The market wants either confirmation or contradiction. A strong print would have extended the risk on. A weak print would have triggered risk off. But a plateau keeps the chop going.
And you saw that in the tape. The move in rates didn't accelerate after the print, and equities didn't really react. It's a holding pattern, which means the next catalyst is even more important.
And from a sector standpoint, you look at consumer discretionary. XLY is up 1.4%, XRT up 1%. The market is giving the benefit of the doubt to the consumer, but only just.
That's right. And when you see single names like RENX near a 20-day high after a 50% 5-day run, it suggests the tape is still willing to reward momentum. But if housing rolls over, those moves are at risk.
And don't forget, if property prices had surprised to the downside, you would have seen a real bid in defensive sectors and a sell-off in discretionary. That didn't happen, so the market is still searching for direction.
So what would invalidate this theme? I'd say if the next round of data shows a clear break, either a sharp drop in property prices or a big spike, then you get a regime shift. Otherwise, it's just noise.
Exactly. And if you're tracking asset sensitivity, you want to watch rates, the dollar, index features, and volatility. If those all move together after the next print, you know the housing data mattered.
And until then, the housing story is a sideshow. Important, but not decisive. The market's just waiting for something to confirm the trend.
Are you seeing any signals in the home building names or related sectors? Anything jumping out?
Not really. Builders are flat, which is another sign the market is just not committing. The action is in the consumer and momentum names, not in the housing-specific trades.
So, bottom line, residential property prices are a key check on the macro regime, but today's print didn't break the tie. The market is still on hold, waiting for confirmation from somewhere else.
And that's why you see the tape so choppy. Every data point matters, but none of them are decisive on their own.
Let's turn to the current account for the fourth quarter, dropped at 10:20. It's a pure macro print, and today, with everything in flux, it's worth more attention than usual.
Normally, the current account is background noise, but in this environment, macro-driven, rate-sensitive, and indecisive, it's a real check on the underlying economic health.
Exactly. A strong current account number says trade flows and cross-border investment are healthy, which supports the dollar and stabilizes rates. A weak number could raise new questions about the growth outlook.
And you can see that in the tape today. The dollar index moved on the number, but rates didn't really react. That tells you the market was watching, but didn't get a decisive signal.
And that's the story of the day. Every print is important, but none of them are breaking the tie. The current account is just another piece of the puzzle, and it's not enough to swing the regime by itself.
Do you think the current account matters more on a day like this, when the rest of the data is inconclusive?
I think so. When the market is searching for confirmation, even secondary prints can have an outsized impact. If the number had really surprised, it could have moved rates or the dollar more aggressively.
But since it didn't, we're left with a tape that's still waiting for conviction. The rates market is watching, but not reacting. Equities are doing their own thing.
And that split is the story of the day. Macro is in charge, but nobody wants to take the other side until they see something definitive.
What would actually invalidate the current account as a driver today? If the next print, maybe retail sales or another macro number, overwhelms it, then the market will just move on.
Exactly. The current account is a second-order driver. If it moves in the same direction as the other prints, you get a multiplier effect. If not, it just gets lost in the noise.
So for asset sensitivity, it's still about rates, the dollar, index futures, and volatility. But unless something lines up across those, the current account is just a background theme.
And that's where we stand. It matters for the regime, but only if it confirms the bigger story.
Let's get into the watch points for the rest of the session. First and foremost, keep your eye on how the tape digests the consumer price index through the afternoon. Does the initial reaction hold, or do we see a shift in positioning as we get closer to the close?
Right, that's the decision point. If the market confirms the morning reaction, you could see trend extension. If it flips, you'll know positioning is getting unwound.
And then there's the producer price index. If the data follows through on the regime, either confirming or contradicting the morning narrative, you'll see it first in rates and the dollar.
Exactly. The first 5-minute move after a print is critical. If rates, the dollar, and equities all move together, that's conviction. If it fades, it's just positioning.
And don't ignore the credit tailwind. High yield, HYG, is outperforming treasuries. That means spreads are tightening, which supports risk on, but only as long as nothing derails it.
If you're watching for sector confirmation, XRT and XLY are both up over 1% on the day. That's the consumer discretionary complex. If those gains hold, it's a signal that risk appetite is intact.
But watch for a fade. If those ETFs lose their gains into the close, it probably means the market is getting more defensive.
And keep an eye on the single name momentum. RXT, SNSE, CDIO, and MLEC are all near their recent highs with accelerating momentum. If the tape sours, those names will be the first to reverse.
On the flip side, JDZG is scraping new lows, down almost 80% in 5 days and 94% from its 20-day high. If that move holds, it's a warning sign for momentum unwinds.
And don't ignore the notable movers. IBRX up almost 33% and HYMC up 29%. Watch for sector read-through and whether these moves actually stick into the close.
For the macro, the rest of the session is all about confirmation. Does the afternoon reinforce the morning regime, or do we finally get a break in either direction?
And if you see the credit tailwind stall or the curve steepen further, that's your early warning for a regime shift.
So, in practical terms, watch the 2-year and 10-year treasuries for direction, cross-asset correlation for conviction, and single-name momentum for risk appetite.
And don't sleep on the cross-currents from Europe. If the Bund Auction results start to spill over, you'll see it first in the long end of the curve.
And if you're in the consumer or discretionary space, pay close attention to whether leadership rotates back to the defensives. That's often the first sign of a risk-off turn.
So, to wrap up the watch points, confirmation is everything. The market is hypersensitive to signals, and the afternoon's reaction will decide whether risk-on holds or reverses.
That's your brief for Wednesday. Stay sharp, and we'll see you next time. Same edge, bell to bell. This is Morgan, alongside Alex, signing off.